welcome to all of you once again. I'm very excited to be here with my colleagues, sharing some insights on the program today. But just before that, we've got a few new faces. So let me just tell you a little bit about BDO. BDO globally is an advisory firm, audit firm. We're the 5th largest in the world with revenues of 11.8 billion. We have a presence in 164 countries and in 1,713 offices with nearly 100,000 professional people. We provide a full range of services, as you can see, and that's our service split there: tax, audit, advisory, as well as business support services. In the East African practice, we're based in 5 countries with fully established practices: Kenya, Uganda, Tanzania, Rwanda, and Ethiopia. And we provide a full range of services here, audit, tax, and within advisory, we look at internal audit, risk management, consulting, insolvency services, corporate finance and transaction services, as well as forensic services. We also provide data privacy services and sustainability services. So that's a little bit about us. Now, today's topic. Today, we're going to talk about risk management and internal audit's role in the evaluation of segregation of duties. We started off with the internal audit in the future, and we looked at technology and innovation, and now we're rolling backwards to the basics. So that's what we're going to do today. We're actually going to the building blocks of internal audit. We're going to look at how internal audit works in practice, because a lot of us simply go into systems without actually learning the basics. So today we're going to talk about the basics. And then in the part 5, we're going to talk about contract management and the internal auditor's role to yield savings and results. This is the agenda for today. I'm going to start off the session with a brief introduction, followed by what are internal controls, what are the basics on internal controls, and that leads us to looking at human behavior and specifically to fraud, and understanding why is it that fraud happens and why do we need internal controls. And then we're going to go and look at some of the reasoning behind internal controls, how they are set up, when we look at segregation of duties, when we look at authorization controls and so on and so forth, what's the science behind it and why do we do the things that we do? And we're also going to look at internal IT's role in segregation of duties and the role of internal audit in evaluating the segregation of duties and what a digital risk assessment looks like. Finally, we've got a really exciting session for you. There's going to be a Finity demo at the end. Finity is basically a platform, and it's designed to support organizations in managing risk and compliance at scale and across several operational and enterprise risk needs and geographies. And the platform deals with a number of things, including third-party risk management, cyber governance, risk and compliance, know your customer, ERM or enterprise risk management, procurement, and data privacy. So, going back to the basics, internal controls. What are the objectives of internal control? First of all, there's the authorization, which is business dealings are performed with management's regular and specific authorization. And then there is actions against deviations. All of the deals are immediately recorded with the proper amount, with the correct amount in relevant accounts and in the accounting period in which they have been completed, so as to authorize the preparation of financial facts within a structure and within recognized accounting policies to hold the accounting function and the organization accountable. And then there's restricted access to assets, which is access to assets only being allowed by means of management's authorization and approval. And finally, there's the prompt recording of transactions. This is action against any deviation. We have accountability for assets, and this is correlated. So the accounts are related to the physical assets at various intervals, and suitable actions are taken with respect to any of the errors. And the types of internal controls, we've got entity level or organizational internal controls. We've got organization controls at the personnel level. And then we've got arithmetic and accounting controls. We've also got controls over authorization and approval. We obviously have physical access controls. And then we've got the segregation of duties. We touched on how fraud happens and why it happens and what is the human psyche of fraud. Why do we need internal auditors in the first place? And why do we need internal controls? Well, we need internal controls because human beings, unfortunately, have a tendency to deviate from the correct path and sometimes to take advantage of weaknesses and internal controls. So if you were with me when we had some of our forensic webinars a couple of months ago, you might have seen this slide already. But for those of you, excuse me, I have a cold today, so I'm just going to take a little sip of water as I talk. So for those of us who were with me a couple of months ago when we did fraud and the profile of a fraudster, we actually looked at this, how fraud happens. And if we start with the triangle there, this triangle is called the fraud triangle, and it aims to explain how fraud happens. It starts off with a need, a pressure on the fraudster. The fraudster needs cash or money, and he can't get it through legitimate means. And unfortunately, he doesn't want to work hard. He sees that there's another way of getting the money, which is obviously illegitimate. What are other kind of pressures? He might have financial pressures. Maybe he's got to pay for school fees. There might be unexpected medical bills. There might be expensive education bills, and so on and so forth. Or he might have bad habits like addiction, for example, to drugs, which is an expensive habit. Or he might just be greedy. He just, has found an opportunity and he needs, and he's taking advantage of it. This other area is opportunity. And this is where internal control comes in. Opportunity is really the open door. When there's a lack of internal controls are weak. There's turnover of key positions, positions of trust. There's a lack of oversight because there's too much trust, or there's a lack of segregation of duties, that people are able to take advantage of the opportunity that's there. Or there are related third-party related transactions where the individual is also the supplier. He's got a supplier and he's actually hiding behind the supplier. He's not providing services at arm's length. And where we use estimates, significant use of estimates as opposed to actuals. And then the last bit on the fraud triangle is the rationalization. This is what's going through the fraudster's mind. Quite often, the fraudster rationalizes his behavior because he thinks that what he's taking is due to him. It could happen. One example is maybe he didn't get promoted and his colleagues got promoted when there was a review, and he feels in his mind that he ought to have been promoted as well. So he knows, well, my colleagues are getting 20,000 or 40,000 shillings or $1,000 more in the coming year, and he sees an opportunity. So maybe he rewards himself $1,000. And initially his fraud could start just by taking $1,000, but then later on he could get greedy and he starts taking a lot more. Or he may have a need, a genuine need, a hospital bill or education, and he's tried to borrow from friends and family, but nobody's lent him money. So he's turned to stealing from the organization. And he thinks at some point he's going to pay it back, only to realize that it's actually not so easy once you've taken money from the organization to pay back. And, your mind rationalizes, taking a little bit more, and so on and so forth. The second diagram there is the fraud diamond theory. And there basically what forensics experts say is that the person also has to have capability. So that's the other red flag. If you've got somebody who doesn't have segregation of duties, there's too much trust, the internal controls are weak, and this person is very experienced, he's got the ability to steal, he's got the ability to manipulate controls, then he will, and he may defraud the organization. And then you got the Pentagon, well, that's the fraud Pentagon, where the other element that was introduced is the arrogance. This person believes he's above the law, he's got an ego, and he believes that everything that applies that in the organization, the same rules don't apply to him, and therefore he's going to be disassociated from the organization. A lot of the organizations, particularly in our part of the world, they are family organizations, and we all get treated very nicely with a lot of respect. We're welcomed as part of the family, but that sort of warmth and approach doesn't work with this person, because this person's always distanced, and this is what allows him to go into fraud. And then there's the fraud hexagon, where there was one more attribute that was introduced, and that was the character of the person. And the character basically of anybody is built through your background, your family background, your religious background or lack of religious background, your moral upbringing, the rights and wrongs that you see, what you filter as right and wrong. So if you've come from a background where some things which are unethical are ethical for you, then it's going to be easy for you to make unethical decisions, because your framework, for filtering those decisions is different from the normal framework that people use. So this is understanding how fraud happens. Now let's look at people. And again, I'd mentioned this before, but it's worth mentioning because these are key. If you don't understand how human beings function, then you can't be a good internal auditor, and you're not going to be able to pick up fraud as it happens, even if it's staring you in the face. So what basically the theory is that there are three categories of individuals, and there are, and you can see that bell curve there, and there are some percentages on that. This is not accurate, it's not science, but I mean, generally it applies across various societies, including ours. So if you start with the red side, this is dishonest people. And what this is saying is that 5 to 13% of an average population you're going to find is dishonest. So if you've got 100 people in a room, 5 to 13 of those, something's happened in their life, some event, but they've basically become dishonest. They are not capable of being honest all of the time. And if you give them the opportunity, then they're going to steal from you. The second one is the green bit, which is honest people. And those comprise 10 to 15% of all people. And then the rest of us, which is 72 to 85%, is what we call situationally honest or situationally dishonest. And they need to be actively managed. So when you talk about internal controls, you really want to manage, the situational people and also the dishonest people. If you've got dishonest people, you're probably going to have fraud at some point, regardless of how much controls you've got, because they're going to find a way of breaking around the controls. So really your internal controls, dishonest people, you've got to try and stop them from getting into the organization in the first place. But the rest, we're talking about nearly 85% of people, those are subject to internal controls. So let's look at what are some of the things that we should be doing with these in relation to these three people. So let's look at the honest people. These guys, they'll always do the right thing, and they represent the lowest risk to fraud, and they're also the lowest headache for risk management and for internal audit. These guys are driven by high moral values. They address social and political setbacks as learning opportunities and as challenges to overcome. If they have an unexpected or financial need, they will work overtime, they will hold 2 or more jobs, They will cut back on expenses and they will seek help from family and friends. They won't dip into the pockets of the firm. And if they come across weak controls, they will notify somebody. They won't exploit the organization's weaknesses, and they will communicate their findings to anybody so that corrective action can be taken and the organization can be protected. Now let's look at the guys in the red, the dishonest people. Like I said, these are people who, unfortunately, they've fallen off the cliff. At some point, they've just fallen off that edge, the edge of no return. They represent the highest risk to fraud. They will seek opportunities to defraud unsuspecting victims. They will continuously test the boundaries to determine management's tolerance for deviations from company policy. They are constantly searching for loopholes and weaknesses for personal gain, and they question authority and rules. They, like I said, some of them are psychopaths. So they will lie, and they should never be placed in positions where they control companies' assets. In extreme cases, they will even suffer from psychological conditions, and they may seek power, success, and grandeur at the expense of everyone else. So dishonest employees will ignore the organization's attempts to create a positive, productive, and controlled work environment, and they will constantly search for ways to beat the system. You want to keep these guys out of your organization at all cost. And the place to block them is at the recruitment stage. So internal audit has to have a big role in designing and monitoring recruitment practices, because that is where these guys get in. Then you've got the situationally or potential honest person or dishonest person. Generally, 85% of all of us are generally honest, and we're disciplined and we're committed. And we make efforts to comply with policies and procedures in our organization. However, this group of people, unlike the honest ones, if there's an open door, they are going to break the rules. They're susceptible. If they find everybody else is breaking the rule, if the organization's culture condones deviation from policy, they may follow their peers in those practices. So for these guys, you need reminders, you need reassurance, guidance, and you need follow-up to ensure their continued awareness and their continued compliance. So when management fails to document or to provide training, and it fails to sanction unethical practices, fraud risks are going to grow rapidly, because these guys are going to join the guys in the red, because everybody's doing it. And sometimes we see this where there's unethical practices, in various segments in our countries. We know where there's fraud and corruption rampantly. You can have somebody who's very good and he joins, but unfortunately, in no time, the guy is also corrupt and he's also, committing frauds of all kinds. We've seen this happening, and this is it's the environment that pushes these guys to the other side. So these people benefit from effective controls. They benefit from a strong top, a strong tone at the top, visible leadership, and clearly documented policies and frequent audits. All of these things internal audit is involved in. And as a result of organizational policies and operating procedures and internal controls should take a risk-based approach when you're looking at fraud. And for internal auditors specifically, you need to look at the organization's employment practices, the tone throughout the organization, and also assess the employees' understanding of the word and the spirit of the law in policies and procedures. So one word of advice to internal auditors, work with HR and work with the softer parts of the organization, because a lot of the times, that's how fraudsters gain access into the organization. So now I'm going to hand over to my colleague, George, to take you through the remaining sessions. George?
Thanks, Zahir. So taking over from where Zahila has stopped, the control activities mentioned by Zahir fall in three broad categories. We've got the preventive, detective, and corrective. And as noted on our slide, segregation of duties fall under preventive control activities that the management needs to implement in an organization. As we all are aware, it's a management responsibility to ensure that they implement control activities that are that will ensure that fraud or error will not occur in those organizations or in their organization. And segregation of duty happens to be the simplest form and the most effective foundation that would, or control that would actually work or deter fraud or error happening in the organization. I don't know whether this description would actually describe how segregation of duty happens in your organization. That you've got a management team that has decided we are not investing in, segregation of duty software because our budget does not allow that to happen. So what we will be doing is, coming in together to actually click so that, we segregate or we work together. As mentioned, the effort towards segregation of duties works towards reducing the risk of one person committing or concealing fraud. And it's necessary to all our organization. And the team within this webinar happen to be, accountants, financial decision makers, chief audit executives that will work towards the actualization of segregation of duties. I'll focus on three areas, not in any order specifically, where segregation of duty is necessary to guard against fraud. Governance, business process, information technology, and then look at your role as internal auditor of financial controllers towards SODs. Now, our business processes fall in several categories, and industry standards, you will define them in 4 areas, which is authority, record keeping, reconciliation, and custody. But in practice, you'll find that there is an initiator, and at the end of it, there is someone in charge of reporting. The basic concept underlying segregation of duties is that no one person or group should be involved in any of these 4 areas, because if they do so, they'll actually be in a position to perpetrate and to conceal any error or fraud in their normal course of their duties. And as Zahira has mentioned, there's always a high propensity for someone to commit a fraud or conceal an error. So when you're looking at segregation of duties, what we'll try and do is do an end-to-end access control management on the processes that we handle each and every day, so that we see in which area, if segregation of duty does not happen, fraud or error is likely to happen. This is a conflict summary based on those business processes that we've mentioned. And it's based on the duties that happen at each point in time and whether conflict would arise if they are not segregated. Taking one by one, if say, for example, the person who is actually initiating a process is a person who is also given the mandate to authorize it, that creates a conflict. And that person is likely to commit or conceal an error. Taking it further, if that person initiates, probably authorizes a transaction, is also involved in record keeping, again, they are likely to conceal or commit a fraud. Okay. Now, one further issue, if say, for example, we're looking at custody, reconciliation, and reporting, the best assumption in any organization is that we assume a forward flow of documents such that the person who initiates, after they initiate a process, which in our case, initiation of a process could be anything from procurement, which is buying, from a sale, hiring process. That person, once they initiate it, the transaction doesn't come back to them and it goes on to the next level of authority. And after it has been authorized, it goes into another person for record keeping, custody, reconciliation, and then eventually reporting. If you don't assume a forward flow of documents, and in a situation where someone does an initiation of a process, it goes ahead to someone else for authority or authorization. Authorization in this case, which could be external or internal. External in the sense that you're designing or someone is signing a third-party contract. Internal, where you're passing in a document for approval to a senior person. It could come back to that person who actually initiated that document or process to actually make amendments and eventually conceal a fraud or an error. So the assumption is that there will always be a forward flow of documents. Otherwise, any backward flow of the same could result to a concealment of an error, commitment of a fraud. So again, if someone authorizes and then is a person who actually doing record keeping or doing custody of whatever documents or processes that they have actually authorized, the likelihood of them committing an error is high. Again, if you're in a position of authority, and at the end of it, you're the person in charge of reporting, a common example for auditors is management override of controls. You are likely to commit a fraud or conceal an error. So this is a snapshot of conflict summary of where conflicts would arise, and they are indicated in red. And the financial controllers, chief audit executives needs to be very careful on any of these areas. And again, as mentioned, the assumption in this conflict summary is that there's a forward flow of documents. Any process within the organization that results to a backward flow of documents, if you're not careful, would result to fraud or concealment of an error. I'll give you a few examples when it comes to business processes, where if you don't segregate or have compensating controls, fraud is likely to happen. For example, procure to pay. If the person who is actually authorizing a PO and the person who is actually receiving the products, those two responsibilities are supposed to be segregated. Otherwise, you'll create an opportunity for fraud or error. Inventory, for example, if the person who is actually reconciling inventory is the same person who is actually doing inventory count, there's likely to be a fraud. That's an opportunity for those in authority to ensure there is segregation. Order to cash, the person who is initiating the sale, then the person who is actually signing the contracts are ideally supposed to be separate people. Otherwise, you create a compensating control where there's an independent review of that process. Order to cash, the record keeping and the custody of the cash needs to be separated. Otherwise, you create a compensating control where you have lock boxes and someone else counting the cash. IT systems. If you've got someone who is updating master files, and if the same person is doing change reports, there's no way he'll report what he is actually changed. So it's critical for those two roles to be separated. Financial reporting, when it comes to journal entries, the person who is passing journal entries and the person who is doing reconciliation, they cannot be separated, and independent review of system reports of journal entries needs to be in place. I'll add a further one, which is a live example within a scope where you find, like, for example, payroll. The person who is creating the payroll and the person who is actually doing the payments, if they are one and the same person, you create an opportunity for that person to create fictitious people within the system and actually pay those people. So the segregation needs to happen. And if that is not taken care of, you create an opportunity for fraud and a risk for concealment of errors if committed. Now, we are operating in an environment where IT is becoming a critical function or an enabler to our doing of things in an organization. And as financial controllers, chief audit executives, you actually need to be very careful with how this tool is being used in your organization. I don't know how many of us have looked at the user's profile, the roles that have been placed on them, and the user permissions on each one of the people who are using the IT tools. There are so many complex systems, ERP that you're using, and it'd be critical for you to actually look at how is the system set up, profile-wise, to ensure that the segregation of duties in the user permissions that have been created. The flow that is on our screen shows how IT flows when it comes to setting up user profiles. And it usually starts with you creating a user, and most likely you will give them a profile, and that profile is attached to some roles. That role or those roles will have permissions, and it's on the basis of those permissions that that person actually transacts within the system. Now, you may usually find yourself in a position where you've given someone one or two roles, depending on how mature your organization is, because depending on the maturity, you'll have enough staffing within your organization, and you'll be advanced in the technology, the IT tools that you're using. So you'll find someone who, or an organization within using a very complex system, for example, and the person who is actually doing the transaction has the mandate to authorize it within the system. They're in charge of the record keeping, they're in charge of posting, and at the end of it, they can actually produce reports in the same system. So essentially, much as you're using a very good tool, there are no controls in that system. It is good for the people within this webinar to actually look at how access controls are managed within the system by use of the role and the responsibility functions to check what are the user permissions that have been created to each user. And we usually recommend that you do them at permission level so that you don't resort to some false positives when you do them at role level, because you can have someone who has 2-3 roles within the system, but they're not conflicting. So if you do it at role level, you'll think that this person is doing so many things, but when you drill down, they don't have the opportunity to conceal anything. So there are people with permissions that resorts to them to only do read-only, for example, or do reporting only, but they can't affect anything on transactions, for example, which is a role maybe which is for the finance director, for example. So you need to be careful and review the user permissions and not necessarily the roles in the setup for profiles within the system. The other thing we'll need to look at is the governance. The governance, when you look at segregation of duty governance framework, essentially what you're looking at is the whole organization and how mature the organization is to be able to look at segregation of duties from a broad perspective. This segregation of duties is not a project which you come in and check whether person A is not doing or is doing this role and person B is doing this role and person C is doing this role. It's a holistic approach to how you monitor every item from the top to bottom, from strategy at the top, the program and processes, and the enablers like HR and IT within the organization, so that when you look at the whole organization, you can actually see that there is no conflict in each one of them. Okay, so you as the financial controller, for example, or chief audit executive, you need to understand what is the objective of the organization. When we come to each of the processes that we have, what do we intend to achieve? And when we put in one man in IT, for example, does that facilitate the achievement of the objectives that the organization expect in that area? So that in that function, for example, in IT, does not resort to any risk. It's common in IT, for example, to find one-man risk where that person does anything and everything and they know it all. So in that case, there's no way you'll ever know what happens and the processes in there. So when fraud comes, errors happen in an organization and that person disappears, you're left wondering how much the organization has left. So segregation of duty is a continuous process where you always planning, delivering, monitoring, and striving to improve the process through a continuous assessment program. What's your role as an internal audit when it comes to evaluating segregation of duties? All the finance directors, controllers in this webinar. You need to understand the business processes, policies, procedures, how they have been designed, whether there are any weaknesses, what is the workflow from top to bottom, what's the relationship. You need to be able to know, besides those workflows that have been put in place, are there any compensating controls? Such that if, yes, the segregation of duties, if two people collude, is there a compensating control such that whatever efforts they put into that collusion does not resort to fraud or concealment of an error? Because we're addressing people at a higher level, the finance controllers, the chief audit executive, you should be able to do independent reviews such that on a continuous basis, you're checking, is there a likelihood of fraud or error happening? Again, you should be able to assess all the controls that have been put in place, be able to come up with exception reports of anything that could go wrong or has gone wrong and strive to improve on it. Most of our systems have transaction logs, system or application transaction logs, which you can continually on a regular basis look at or audit trails, so that that automation which you've done does not resort to a concealment of fraud. As I mentioned, and as Zahir mentioned, we are looking at risk management and isolating one element out of the whole risk management process to see how we can address that. Risk management is a process, and it takes a few other, or focuses on a few other things within an organization. As mentioned, we have a partner with us who have a digital risk management platform that as an organization we can use or implement so that we can be able to get out of use of Excel, for example, which is one of the tools that we commonly use. And at this point, I'll invite Lee to take us through the digital risk management platform that they've been out in the market selling. Lee?
Thank you very much, George. Really appreciate that. So yeah, just from a quick introduction, the Affinity platform looks at a number of areas when it comes to risk and compliance management. We're going to be focusing primarily on—
Sorry, Lee, you're muted.
I'm not. Can you not hear me? I'm speaking.
I hear you, Lee.
Okay. Thank you very much for doing that. Okay, so as I was saying, is just in terms of our focus today is going to be around the internal controls and compliance, or the risk and controls and compliance, as well as the external risk and controls and compliance. But just to kind of give you an overview of the platform so you understand where it fits in, we cater for the enterprise risk management in terms of identifying what are the strategic, tactical, and operational risks. So in this instance, what we're going to assume for a second is that you have a strategic risk, which is relating to third-party risk management. It's a really big area and a big concern for a lot of multinational organizations as they try and manage their supply chain and the risks associated to that. If you take a risk-based approach to your compliance, you've also got things like your privacy risks that are coming on board, your cybersecurity acts that are kicking in, and you need to ensure that all of these are embedded effectively into the organization. And to also just keep with the theme for today, one also needs to ensure that there is segregation between the different parts of the organization, and we will touch on that. Yeah, I think if we could just move to the next slide, just to finalize. So just in terms of the actual risk management platform, we can cater for things like third-party risk management, your cyber governance, risk and compliance, know your customer, enterprise risk management, procurement compliance, data privacy, and information security. We, of course, do not have that much time, so we're going to just keep it on the third-party risk management for today. So I have a demo prep for us. So I'm going to take over the screen sharing right now and take us through the actual presentation. Thank you. So at this point, you should be seeing my screen. And if there's any challenges, then just kind of put it into, yeah, just put it into the notes, but let's get into it. So just from an Affinity perspective, this is the Affinity platform. When you log into the platform, it's very similar to the hierarchy. We're going to be focusing in on the third-party risk management. I just want to hide this floating panel. There we go. And when we log into the actual platform, what we're presented with is high-level, easy to understand navigation. So I want to paint a little picture for us as we get into what is third-party risk management. So I want you to pretend for a moment you're in an organization, sort of 500 to 1,000 people. You have your policies in place. You spent a lot of time trying to understand your gap analysis around your privacy, around your cybersecurity. And you're now in a position where you've got all your Excel spreadsheets with all the different questions that you send to your vendors as they're going through the onboarding process. Procurement's brought into it, privacy teams, the cyber teams, the IT teams, and everyone knows what they're supposed to be doing, but it's all very manual and there's lots of Excel spreadsheets floating around and there's emails. Vendors are taking forever to get onboarded. You know, things are getting lost, and the business is actually being almost impeded by the level of risk and compliance and controls that are now being enforced into the organization. And it is at this time that you're ready for automation. So let's get into what that could potentially look like. So when you are at that point, let's go through the concept of onboarding a vendor when you're at that level of maturity. So in this example, we're going to just add on board BDO Africa. As the vendor in question, we would typically put a more detailed description. The internal relationship manager would be somebody in your organization, and maybe the external individual in this case would be Lee at BDO Africa. So really what we're trying to do is determine what types of controls actually need to be used to onboard this particular vendor effectively. So this is like a high-level questionnaire to basically do a risk profiling on that vendor. So as you can see, this is the only thing that the business unit would see. They wouldn't really see the actual inside of the platform. They would just simply need to understand how to operate an email link as well as a browser. So in this instance, they get to determine what type of third party it is. And as you can see, it's either an IT vendor, general third party, or insurance broker. In this instance, I'm going to select the IT broker, and immediately you saw that the second question has been removed. What that means is that Skip Logic has actually been enabled to support the flow of this assessment to really get the recipient to answer the most important questions that are needed to risk rate this particular vendor. So this just gives us an example. So let's assume $50,000 is the spend, and the impact to our customers is $500,000 in this particular instance. The next step is to determine what sort of access they require. So I'm going to highlight a hybrid access, and the next step is to determine what is the level of customer access or personal information that will be accessed. I'm going to select strict restricted in this instance, and then of course, what would be the impact to our customers. So based on a very quick example, we've now determined what is the inherent risk rating of our particular vendor, in this instance, BDO Africa, and what is the right kinds of controls assessments that actually need to be triggered for this vendor to be onboarded effectively according to our policies, our procedures, our standards, and the Excel spreadsheets that we would have developed previously, that we've now implemented into a digital platform. And the answer to that question, based on the high risk rating per the previous answers, as there is a high impact on our customers, there is a high level of data privacy that is used, and it's a SaaS-based application. So in this instance, an AML will trigger, a business resilience will trigger because of the impact to our customers, COVID screening will trigger because of the on-site potential access that is required. ISO will trigger because, again, of the information security, and cyber will trigger because of the SaaS component that they're going to provide. So what this means is that the actual platform takes on the intelligence of the organization. And that allows the organization to actually streamline, move away from manual processes, all the Excel spreadsheets, versioning control of various Excel spreadsheets, where they are, the scoring, all of that kind of thing, because it's all embedded and ingrained into the platform. What this also allows us to do is it also allows us to bake in recommendations. So based on the way that that particular third party has answered that profiling question, or if it was answered internally, we now know what we need to do next. So you can actually provide this to grads or whoever in your organization, because you've actually baked the knowledge of what is expected into your organization. You can scroll through the various responses and of course determine and understand where the risk is actually sitting within this particular assessment. You could also add a treatment action relating to this particular item, and you can see how it was automatically populated, again, allowing us to capture remediation items. So the way that this would typically work is that one individual would answer these questions. It would then go to procurement for them to review the responses. against segregation of duty in this particular instance. And only once their reviews are actually happy that the answers have been answered effectively, they can then close the actual assessment. Before we close and actually trigger off those assessments, the other interesting thing that our platform allows is that it will actually pre-populate the responses into those assessments. So AML internally or business resilience externally, and COVID and ISO and NIST accordingly, if they're going for reassessment or if they've answered other questions in the platform, maybe unrelated to onboarding, it might be related to application assessments or whatever the case may be, which is a really great way to ensure consistency in terms of answers across every element that you're trying to risk manage. So I'm going to trigger those assessments. And now what happens is that we now have we've triggered the onboarding process for BDO Africa. And that basically allows us to now go through the motions of managing that particular vendor from end to end. So if I go across now to our register, we'll see all of our third parties that we have available within our platform. And there we go. So that has been triggered. If we go across to our register, we'll see all of the third parties that we've previously captured, including our BDO Africa. And as you can see, that particular item has now been loaded into our register. We also have the ability to not only do one at a time, but to do bulk assessments as well. So under our assessment manager, we can actually trigger through an upload process all of the various third parties that we would want to onboard via an import process, and then trigger bulk controlled and profiling assessments to manage previous or historic assessments, as well as manage going forward. But what does good look like? I think that's always the question, you know, what should we be aiming for? So here is an example of an organization that has been onboarded. Again, this is just an example for Amazon Web Services. So based on the inherent risk rating, it came out at a low risk. However, it still was handling high privacy data. Although the overall risk was low, there was a privacy risk associated to that. We know which departments it was associated to. And then also what we can also do is bring in additional feeds. So these would be things like your know your customer feeds or KYC feeds in this particular instance. So you can see there's a risk rating of 5.7. So there's a risk rating that is slightly higher than the inherent risk rating. And then we could also bring in cyber risk rating feeds. Again, this is based on surface scans of that organization to potentially identify not only internal risks, as well as external risks associated to that. One of the most important parts of any kind of engagement and the risk and compliance associated to that is managing contracts. So in this instance, we're pulling all of the contracts, all of the SLAs, all the MSAs into a single area. And then, of course, we're tracking every single one of those assessments from start to finish, through the review process, through the reassessment process on an annual basis. Because one of the most important things that you want to do is you don't want to be in a situation where you're going to be a once-off and every time you have to start from a base zero. And you saw how you're able to capture pre-assessment information. It's the same again for reassessment. And one of the most important things in terms of pulling everything together into a single location is you want all of your evidence, not only just your contracts, but all associated evidences that has been provided by that third party, all of their policies, all of their standards, all of their responses in a central location, in a single pane of glass for this vendor. So that includes who the internal relationship managers are, the external relationship managers, cyber information, know your customer information, and all the evidence. So the last part of the puzzle is, of course, the retrieving of the change history. It does take a little bit of time to load, so I'm not going to load it over here. But the idea here is that you'll be able to see every single change, no matter who changed it. So if you think about first line operations, second line from a compliance perspective, and third line from an audit perspective, every single one of the lines of defense can use the single page to be able to understand how the vendor was onboarded, who onboarded it, who accepted the actual onboarding process, who accepted the due diligence, what are the evidences associated to it, Were there any recommendations? Were there any remediation actions? Were they addressed within the given period of time? So that's what good looks like. The next step of good is understanding what are your risks across your third parties. So very quickly, we can see we've got a number of the parties under management. We've got 72 in total. 67 are active, 49 are very high risk, 9 are cloud, 20 are relating to the IT department, and 26 are unassigned, which means they're a potential high risk to our organization because we have not assessed them. The overall inherent risk ratings across our organization, and where is the concentration of our risk? And that's basically in this area over here relating to 7 particular vendors. Now that is where we need to be focusing our attention potentially, but it also from an audit perspective allows you to get a sense of across the board, where is the risks and be able to do sample analysis of each one of those vendors. Again, you want to understand what is the coverage across the organization and what are the recommendations that have been triggered and have those recommendations actually been followed through. This is something that an audit individual would want to know. The next step is just in terms of RAG reports. So you often want to kind of get really down into the detail because you guys are very used to Excel spreadsheets, understanding, getting into the nitty-gritty. And from a platform perspective, that is also really important. So this is an example. I've moved away from the ISO, but have gone towards a NIST assessment in this instance. On the left-hand side are all of your controls. The next column is a summary of all of those controls across your entire ecosystem. So in this instance, I'm only really pulled in 5 different vendors. But what you can see here very quickly is relating to physical and software assets that have been identified. You've got a compliant ratio of 40% across your stable of third parties that you're assessing. So from an ops perspective, this should be a massive red light for you. From a compliance perspective again, and from an audit, you can know that your first and second line are actually doing what they're supposed to, because the next thing that they'll then be able to do is add a treatment action for every single one of these vendors and track it all the way through to treatment. So if I were to add a treatment item for this particular vendor, so it's a new vendor in this instance, it's relating to IT services for the finance department. I'll select audit over here, and we have a number of individuals that we want to capture as part of the treatment action. The agreed treatment action is that assets will be classified, and then we'll assign it to a particular individual. The automated dates are already tracked. The risk assessment has been selected. And in this instance, Joshua and Elton are the reviewers of this particular risk item. This will allow us to actually trigger all of our treatment actions and manage each one of them in totality. So I'm not going to navigate away from this particular page. I'm going to navigate to it via our landing page resilience. And if we go into our risk register for all of our treatment actions, we'll see all of the various treatments. And again, this is not just third party. This is all of your treatments. This is your enterprise risks in terms of items that were identified part of your last risk workshop or specific risks relating to accounts payable. But in terms of what we're looking for, we are looking for our new vendor, and that risk has now been assigned to Lee with a set date by when he has to remediate that. And in this instance, I'm Lee at BDO, and I need to be able to assess that. And in this instance, Elton and Joshua will be the reviewers. And if they are not happy with the responses that I provide to them, they in turn will be able to reject and or request for information. So in this instance, I'm just going to say that it is completed, evidence attached. And I'm going to select the evidence associated to that item. There we go. That's it. And what that will allow the individuals to then do is actually close on that particular item. So it closes the complete loop from end to end. So if I now go into that particular vendor, Lee as BDO has reviewed it. Now Josh and Elton would receive a link to go in, have a look at the evidence provided, and confirm that they are happy. There is the evidence associated to that. And once they are happy, they can actually then say, we are going to either mitigate this risk, or this risk has been mitigated, avoided, transferred, or if you were not happy with it, or if they were not happy with it, they would simply accept the risk. That is it from an overall demo perspective. I'm going to hand back to the rest of the panel now. Okay. For questions and answers.
Thank you so much, Lee and George. And that brings us to the end of our session for today. I'm hoping you found the session useful. If we have run over by just 4 minutes, if there are any further questions, there were a couple of questions which I answered. I took the opportunity to answer them as the thing was going on, so we wouldn't keep you here for longer, but I'll hand over to Virginia.
Thank you, Zahir, Lee, and George. Thank you, our attendees, for joining us today. We still have one more part for the internal audit webinar series. We'll be closing this particular series, not the last one. We'll have another series on coming for you on the 10th of November, and the topic will be contracts management and internal auditors' role to use savings and results. So would request that when the invites get to you and that you find the relevant people in your organization, that this will be of use to extend the invite, and we'll be glad to join you. If you have more questions that haven't been addressed, you can easily reach us through the same email that sends us the communication. Your request will be forwarded to either of the members of the team. Thank you for being with us. Our apologies for extending about 6 minutes longer. See you on the 10th of November for the final part. If you missed out on any parts, we have our YouTube channel, Video in East Africa, and all the presentation will be there. Goodbye for now.
Thank you. Bye.